Hi everyone. I'm Toby Turtle, the official mascot of STO Summit Spring 2025. We're excited to share the recorded sessions from the world's leading summit on security tokens and real-world assets. Hey Jason Barraza, over to you.
Happy to be on this panel and looking forward to a good discussion. My personal background, I began working in ag tech. I built a company within satellite data and AI that got acquired recently. So I built that up over like 5.5 years. And then I went to build a token which tokenizes carbon assets. And so we tokenized around 100 million of carbon credits and had about 4 billion of volume on that platform. And then went on to build Cork. And Cork is building tokenized risk markets. So we have around 17 million of tokenized risk currently on our platform and are scaling up that side of the market.
Appreciate that. Manish, why don't you give us an overview on what you're working on here and yourself?
Yeah, certainly. So I'm the co-founder CEO of Alphaledger. Prior to Alphaledger, I was at a firm called PIMCO, the bond market shop out of Newport Beach, California. I was there for 20 years, helped build the core infrastructure, helped them launch actively managed ETFs, build the technology for the mortgage desk and the cash desk, and then really saw tokenization as an opportunity to improve the bond market, the fixed income market. And so we started the firm in 2019. And to date, we have tokenized well over 800 million in municipal debt. We are the first ones in the U.S. to really do it. We also built a broker-dealer and a transfer agent during Gary Gensler era. That was sort of fun activity, I would say. And becoming the first ones in the U.S. to record municipal debt on blockchain was an interesting journey for us as we sort of got into tokenization. And now we are entering a new stage in our journey where we're launching a actively managed tokenized alt income fund with a target distribution of 12% with daily liquidity on Solana.
Very cool. And you mentioned one of the first, if not the first, it sounds like muni bond here. What year was this, by the way? Just curious.
So we did municipal loans in 2020, and then in 2022, if my memory serves me, we recorded municipal securities on chain. That was the first time securities were getting recorded during that era for the municipal debt.
Nice. So it sounds like you beat JP Morgan's back then Onyx, now Connexus, to doing it with the city of Quincy.
Yeah, so I think the Quincy deal took place last year, I want to say. We have done much more than that. I think there was a small $10 million deal, so kudos to them. But interestingly enough, I did the first Wall Street trade with JP Morgan when I was at PIMCO. That was the Yankee CD blockchain on their Onyx platform. Yeah, I think that's what it was called, Onyx.
Yeah, back then for sure. Yeah, I think it just rebranded to Connexus late last year. I want to say was the timeline there. But no, fantastic. For everyone in the audience, anyone new, my name is Jason, COO at Security Token Market, or STM.co. We are the original and largest data repository for RWA data. So we track over $63 billion worth, over 800 tokens, all tokenized real world assets. And of course, anyone that we aren't tracking yet, let us know. We'd love to track you too. But this conversation again is shifting it back to U.S. Treasuries, stables, and cap markets here. Let's set the stage a little bit. Why are U.S. Treasuries emerging as kind of like the flagship asset for tokenization so far?
Go ahead, Robert.
Well, I think there's clearly the T-bill market is like a major one. I think it is an interesting building block to be able to leverage it as relatively risk-free dollars that you can sort of composably use. I think in particular in DeFi. I think if you're looking at some of the largest purchasers of some of these T-bill products, you're seeing a lot of, for example, Athena, they have purchased a fair bit the digital BlackRock T-bills, and you're seeing a lot of other similar types of integrations where it's being integrated into various lending markets, and bridges and so forth. to generate sort of native yield in DeFi. And so I think that's part of the reason why you've seen a fairly big adoption there, because you can effectively call it sort of risk-free, and you have relatively large like pipelines to also redeem these shares. So I think that's, to me, is one of the drivers, is in particular the composability element.
Yeah, I think that's correct. I think Jason and Robert, I think our thinking at Alphaledger is that there is an arc of tokenization, and the first phase really was the primal instincts to sort of really create the infrastructure. So once the infrastructure was created, it created these crypto assets, and that led to a lot of these meme coins, obviously Bitcoin being the original one, and then from there you had ETH, and you had all the rise of the crypto coins and tokens, is however you want to sort of contextualize that. That led to a creation of an ecosystem that created a casino effect. And from the casino effect, we obviously saw the bear market happen. And the next natural stage for what I call the phase 2 in this arc was the adoption of stable coins, effectively a way for us to move money between people, because it turned out that Bitcoin effectively became an asset class that was buy and hold. Perhaps you can use that for collateral lending, but primarily it's not being used to buy pizzas anymore. It's really a buy and hold asset, and it's an asset class in its own right. So stable coins effectively become the fundamental building blocks for the movement of money, and blockchain obviously allow for atomic settlement. So this becomes a critical component of financial products moving across investors. And if you think of the US ecosystem, the Treasuries obviously have been a very stable instrument. They are a safe haven. Lately, they have not been acting like one, just because of the current political challenges and some of the policy challenges that we have. But by and large, Treasuries are the most stable instruments that are out there. So when the world's looking at stable and stability on chain, this became the natural course of the interaction by the investors. So you can go from a crypto asset to a tokenized treasury, and that really becomes the two pillars today on a public blockchain. So that's why you're seeing the rise in the tokenized treasury funds, whether it's BUIDL, whether it's Benji coming on, and so on and so forth. But what that sort of really leads to now is a massive chasm between the two sides. One is a safe 4% less yielding asset. Another one is volatile 20 plus high risky, high reward asset on the other side.
Appreciate that. Yeah, please, Robert.
Sorry, just to build on that point, I think I completely agree with that sort of those two different like parts of the market. And I think in particular, we've seen really a mass growth of this sort of stablecoin market. And I think an interesting element to that is that most stablecoins are largely backed by different like T-bills. And so in a sense, you already had like, let's say call it 200 billion or so of stablecoins. And now you're seeing sort of the actual T-bill, like tokenized T-bills kind of catching up to that. Because in a sense, when you're holding a stablecoin, you're actually holding a T-bill that's just sort of like wrapped and you're not getting the yield yourself. And I think you're starting to see like a little bit of a shift in that market as well, where people are starting to pass on the yield to the user. Because if you're having that exposure anyways, like why wouldn't you actually just get the yield? And I think you're seeing more and more of that sort of stable part of the market. I think stable coins are still going to continue growing. I think it's, clearly there's like a lot of use cases for that type of design as well. But if you're playing in that safe part of the market that Manish just like talked about, you might as well be also getting the yields. Like if you're taking on like that minuscule risk of holding like T-bills anyways from stable coins, you might also have that yield passed on to you.
Makes sense,
Yeah,
right?
that's correct.
Go ahead, Manish.
No, I would say that's correct. Look, I mean, the minute you start offering yield on a stable coin, it becomes a security. So if you're holding a security, you might as well get the full benefit of a security. And I think that's why you're seeing the rise of tokenized funds. But there's still a massive gap between a tokenized treasury fund, a stable coin that's potentially yield-bearing asset over time, versus the crypto assets. And so I think that's the middle mile, is the part that at least my organization is focused on filling and bringing on the yields to the public chain.
And you know, Manish, I'm so glad that you said funds, because I think that a lot of people call these like tokenized treasuries, and it's like, no, like they're not. The actual treasury isn't tokenized. The fund that invests into it is tokenized, right? And so you have liquidity funds and the sort that we've seen, of course, as examples, money market funds and the sort. So, you know, interesting distinction there. You're right. You know, a lot of these stablecoins are essentially, you know, selling U.S. debt at the end of the day, because that's kind of what backs them and whatnot, and treasuries. And I do want to get into backing and whatnot, but before that, just while we're on the topic, and we were chatting a little earlier about, you know, why U.S. Treasuries are kind of the, you know, this safe haven. The Fed is supposed to give their decision on interest rates tomorrow, actually. So how would that affect one way or the other tokenized treasuries, if at all?
Look, I would not speak as an economist, but I can tell you that, you know, regardless of the economic cycle and the monetary cycle that we are in, U.S. Treasuries have played a very critical role in people's investments. They are still a very safe asset class. We can discuss the fact that the yields are dropping south of 4%. We can talk about whether the yields will rise up or fall down, depending on where the policy and where the comments come on the X platform tomorrow. So I think a lot has to do with how the government reacts to the Fed statement. So I'll withhold any more statement on that front, just because we don't know how the Fed is going to react. And more importantly, it's going to be how the administration reacts on top of Fed's statement.
Makes sense. Robert, any thoughts there?
No, I genuinely agree with that. Like, I think there will be a market for this, even like if rates drop. Like, I think there's at some point, if the rates drop very far, which I think in the very near term they're unlikely to do, but if they drop by, like, you know, even like 100 or 200 basis points, I still think you're going to see meaningful demand on chain for like tokenized like T-bills or funds around that concept, because like you need to have some sort of stable collateral, and you want to earn a yield from that stable collateral. And so I think, you know, that demand driver will still be there.
Yeah, look, so if the Fed is data driven, the rates will reflect that. The yield will reflect the sentiment in the market. But I think that really starts to highlight the opportunity set, which is the missing mile between the two asset classes, right? So there is a treasury, as I've said before, and then there is a crypto. And so as we think about tokenization and tokenization of assets, what's really important is treasury becomes the starting benchmark to where the assets can be compared to. So we have never had that before, at least in the blockchain, public blockchain world. Now we do. So what's the next asset class that we can think about, which is, you know, deemed real world asset, but it could be a corporate debt, could be a municipal debt, could be structured products, could be alternate options and fixed incomes. They all start to become more mainstream, and they become a viable instrument to be brought onto a public blockchain, obviously through a regulated fashion. Clearly will require KYC and AML, but I think that's the reality of where the blockchain is moving towards, which is a more sophisticated atomic settlement infrastructure that supports KYC and AML.
Appreciate that. And I'm glad that you also brought up, you know, again, going up the risk curve a little bit too, to see what else is going to be coming on chain. We see private credit also starting to pick up steam, especially this year in terms of issuances, not just on chain, but overall, you know, off chain as well. So that's really interesting. Well, shifting focus from treasuries over to kind of stable coins again, they kind of go hand in hand, but stable coins are often backed, as we've been saying, you know, by off-chain treasuries. However, we're also seeing tokenized liquidity products also being used for treasury management across other tokenized products, or even DAO treasuries also allocating, you know, some of their treasury into some of these liquidity products, right? So what are some of the implications of this as it relates to stablecoin issuance, backing, or even regulation? Just any thoughts on that, and again, how some of these stables are using treasuries to be backed?
Look, I mean, from where I sit, there is really, you know, one stable coin in the US that has effectively become pretty dominant player, which is USDC Circle. And as the banks start to think about offering stablecoin, that starts to change the paradigm and the nature of how DAOs and how traditional asset managers, how the new asset managers on public blockchain are going to interact. So I think to me, it's a field that's sort of unfolding, but I do believe bank-based stablecoins are coming, and they're going to come fast and furious in terms of treasury management. The on-ramping and off-ramping is still a big challenge, right? I mean, Jason, if you think about how these treasuries are bought, they're still bought through off-ramping an existing stablecoin, whether it's USDT, DC, DG, you can go down the laundry list of assets. They still require the ability for the KYC component from the wallet, where it's coming from, who it belongs to, and where it's going to go. And if it's going to go into a treasury fund, then it requires the off-ramp capability, which still that means it goes through a traditional US bank by and large. And my thinking really is that banks will start to come on, and I think there's a bank, Vantage Bank out of Texas, that just supported Custodia to launch the first bank backed US stable coin. And it's on Ethereum, I believe now, but perhaps soon to be on other blockchains as well.
Yeah, I think just to add to that, I agree. I think there will be like an increasing like proliferation of various different types of stable coins. As like I think if you look at Tether, for example, and if you look at the amount of profits they're generating each quarter, I think that's simply a massive opportunity, because it's holding, like, being an issuer of a stablecoin is can be highly profitable, and I think that kind of provides an incentive for all the like various issuers, or that like all the types of institutions that can issue a stablecoin, to have a strong incentive to do so. And I think also with infrastructure like M0 and so forth, where you have a fairly kind of low barrier to actually like issue these things from a technical perspective. I think you'll likely, as the regulation like clears out and the playbook clears out, see a lot of these actors that have their own rails, that have like they own the user and they have their own ecosystem. Like they can quite easily integrate their own stable coins instead of using a third party one. But on the other hand, that's kind of been a thesis for a while, and still, if you look at sort of stable coins like market caps, like we still see like Tether and USDC like completely dominating. And I think a part of this is just simply the like liquidity network effects of these tokens. And I think that's not going to go away. You have just simply extremely deep liquidity on some of these markets. And for a lot of like use cases, especially if you're doing like trading and assets pairing and things like this, you're just going to be gravitating towards like one or two of these stable coins, and just having this sort of nexus of like liquidity and like nexus of volume is just very sticky and very difficult to displace, especially since these have already generated so many so high amounts of profits. They have the financial means to like keep these moats going. So I think on the one hand, you likely will see like bifurcation of stablecoins and a lot of like smaller stablecoins that are use case specific. But then at the same time, I do think you'll see like one or two major winners. And I think a lot. I think with many of these markets, it becomes like a winner takes most scenario due to these like network effects. So I think you will see a bit of both happening at the same time, and I don't think they're necessarily like mutually exclusive. I think it's just separate use cases, and so to me, that's likely where that space is headed.
So on the one hand, we have Manish, you mentioned, a bunch of banks are thinking of, or actually kind of doing now, issuing stable coins. And Robert, you're also saying, there's kind of like your front runner winners, and then everyone else, right? So when you see stable coins and tokenized treasury type products being issued on multiple chains, public and permissioned, different platforms, different issuers, banks, asset managers, even fintechs like PayPal are, entering the game as well. Is this leading us to then like a future of fragmented liquidity? Or I know, Robert, you mentioned maybe like specific use cases for some, or how will we reach the interoperability and standardization that's needed to reach efficient markets then? With so many different stablecoin options. Yeah.
I'm not sure if the liquidity fragmentation is necessarily so much of a problem, because I think for many of the financial, like the markets where you're, let's say, trading like ETH or like BTC, things like this, where there's like really high volumes, I think it's mostly going to be settling in one type of currency. And I think you need to have certain like levels of liquidity to be able to trade between the stable coins, but you generally have fairly effective redemption mechanisms. And I would say that those redemption mechanisms themselves, they act as sort of the floor liquidity. And then you have like arbitrage bots that are basically like managing all that and making sure everything stays like sort of at par. So whilst I agree, I think you will have some like level of fragmentation. I still think you will be gravitating towards like a handful of these assets, and then going between them, you will probably have fairly like, because the risk of going between them and sort of taking the minor spread that you might take between them and like to perform the redemptions, like I think like those markets I think will be quite effective, and I think the spreads there will be fairly small. I mean, I'm sure there will be some spreads, but like in the end, it's like you're facing spreads going from any currency to any currency, and most likely for your day-to-day usage, you're going to stay within one ecosystem and not going to be making those trades. But even if you do, I think you'll probably, you're probably talking about a few basis points, not like major spreads that will come from the fragmentation.
Yeah, really, really thoughtful there. Manish, I don't know if it sounds like you're like in deep thought here, so not sure if you have anything to add there.
No, I think Robert made some excellent points. Like to me, I think fragmentation is not a bad thing. I think it's going to be survival of the fittest. Any platform that sort of attracts the volume will sort of come out of the top. But with fragmentation comes an arbitrage opportunity, and I think that's what the financial markets are. I mean, like look, today you have NYSE, NASDAQ, ICE. I mean, if you look at the traditional markets, you know, they are fairly fragmented. I mean, if you think from a volume standpoint, they all sort of focus on certain asset classes. So it's not a new phenomenon, at least to me, coming from a traditional infrastructure market. But it's certainly, what we are seeing are early days of and financial ecosystem that's being developed. And so it sees the highs and the lows, but it sees highs and lows instantaneously. I think that's the big delta between what we have seen in the past versus what we see today.
Got it. Okay, very interesting. You're right. I think a lot of things that happen in TradFi markets obviously either get duplicated a little bit on chain with more efficiencies, of course. Other things get disrupted. So I'm just curious to see how this kind of evolves. The Genius Act, and everything else that's involved, I think will also start determining, other people that will enter or maybe even still hold off. We'll see. I do want to get into maybe more specifics on each of you because I think you both bring interesting points of view here. Robert, you work, you mentioned in the beginning, you kind of work with tokenizing risk, right? And we talked about how some of these stablecoins are backed by off-chain treasuries and other sorts. Are there any new risk considerations when you're tokenizing some of these assets? And what are maybe some of the causes of depegging, or how does it apply to these stablecoins versus synthetics? Just curious to pick your brain on maybe risk and how that applies in this area where I think we can all agree, as we all mentioned multiple times, treasuries are some of the more safer assets.
Yeah, I think it's a really interesting sort of area to be exploring at this time, because I think we're seeing now the growth of sort of institutional deployments in the space, like they're starting to creep into the space, and I think as the regulatory like framework like changes, I think you're going to see like increasing large scale institutional adoption of these various products. And I think with that comes an increased sort of, I think, emphasis and importance of risk management. I think when you're looking at these various like pegged tokens, like really, the peg is a story about sort of two different assets and their parity. But really, it's just a story because the two different assets have oftentimes different liquidity profiles and redemption profiles, and have flows going in either direction. And that naturally causes like temporary sort of peg deviations. And sometimes these peg deviations are sort of, because certain like types of risks actually play out. I think USDC, as we mentioned before, is like, I would say probably deemed as maybe the safest stablecoin, but even they experienced like a major peg deviation like a few years back when SVB went down. And so I think if you're looking at these different tokens, there's like risks embedded in them at various layers. There's various like smart contract risks, there's various like custody risks and so forth. And just the mere fact that you have inflows and outflows that can be sometimes very sharp can result in like different types of depegs. So I think I would view it as like I think our understanding of the risks here are we're still sort of developing that understanding, and I think the infrastructure in terms of like risk management is still at its infancy. And I think to see this large scale institutional adoption, I think we have to increase our like ability to like understand, like quantify and hedge and trade these risks. And so I think that's going to be a major like a major piece of really accelerating the space in the sort of institutional era of our RWAs and stablecoins.
Yeah, absolutely. And we've even seen, risk assessment firms and ratings agencies starting to also evaluate some of these products, and side by side too. It's like, look, here's all the ones that look alike. Here are the differentiators, like Particula, Credora. We've seen Moody's even come in and the sources of some of the legacies as well, which I think is really important just to establish credibility and trust on new products. But Robert, you make a lot of good points here. And so when you say you tokenize risk, just want to learn a little bit more about what exactly does that mean, and what would someone be essentially investing into?
Yeah, so we basically create a type of swaps product. We call it DPEG swaps that allow you to trade basically the peg between two different tokens. And we have a swap token that allows you to make a swap in one direction at any time, and it's without oracles. And so someone can underwrite that risk. So you're basically underwriting the risk of there being a DPEG, and then someone else can take on the other side and basically hedge the risk of a DPEG. So that's we see this as sort of one of the building blocks that we need to build out in terms of like what I mentioned with sort of growing the institutional adoption. Like right now we're at a like relatively small scale. We have like 17 million or so of TVL. We launched this like fairly recently, but we see this eventually kind of like as you're tokenizing more and more different types of like credit products. In particular, I think once you're getting into like different types of credit products with different risk profiles that are like higher than, let's say, T-bills, I think you start needing to have this type of like credit default swap like infrastructure. And I think that's a type of tooling that we think will be important in the future, especially as you're going into like munis and like corporate debt, et cetera, and like structured finance. I think there you really start needing to have these things because in my view, I think we want on-chain like tokenization. We wanted to bring benefits across the stack. I think it's a much more efficient like infrastructure and tooling for these products to exist. But risk management is like a major piece of the cost for most financial institutions, and we also need a risk management stack to be best in class. And so I think that's what we're hoping to build out.
Absolutely. I think a lot of people think of tokenization as just putting it on chain. It's like, no, that's step one. That's the easiest part, actually. It's everything else, the legacy systems, the risk management and the new implications that come with it, the whole supply chain, essentially. So, no, I'm glad that this is and I'm honestly very intrigued on what you're working on here. Manish, also on your end, you mentioned the T12 fund earlier in the intro. Curious on maybe how tokenized treasuries or even other tokenized types of asset classes will impact your ability to engineer yield or structure products a bit more effectively, and what your approach is there.
Yeah, look, I mean, as we think about the market, we are looking at from a yield perspective. So like, as I mentioned, there is the treasury funds that have done extremely well, and they are effectively yielding now less than 4% return. And then you have the crypto on the other side, which means there's a massive chasm in between the two asset classes. And it also means that a lot of investors, if you think about the deployment of stablecoin, right? There's some $240 billion of circulation, but probably 50% of that is simply sitting captive in a wallet looking for the right investment opportunity. So as we think about engineering yield, one of the most critical component is, will I invest in my own fund? That's the question number one that we ask collectively as a team. And with our collective experience, what we are leaning towards is we want something that is definitely north of treasuries, south of crypto to reduce the volatility. And where we ended up was with our first fund that's going to get launched on Solana is going to have a target distribution of 12% with daily liquidity, right? And that's because we want to create an ecosystem which allows investors that are accredited investors and above to come into a fund, and then also have access to same level of capabilities that crypto natively provides, which is daily liquidity. We would like to get to a 24/7 trading environment, but I think these are just baby steps that we are taking as an organization and just to be mindful of the investors. So that's the first product. As we think about the next phase in our journey, I think it is not far-fetched, from my opinion, that you can start to see tokenized ETFs coming on. Some of them may be existing ETFs that get tokenized. So it's like a identical twin that's running on a public blockchain, or it could be directly issued stocks that come onto the blockchain. So I think the foundation layer effectively is now built. You now have stablecoins that can transact between products. You still have to worry about off-chain capabilities, but the T12 will start to act as a bridge between the crypto asset class and the treasury asset class, given the distribution rate that we're able to produce through alt income strategy options into this fund. And then clearly we are focused on the liquidity component, which then allows us to make sure that the token will be available to the investors as a collateral instrument.
I would agree with your prediction there on the ETFs and indices as well, and whatnot. I had the pleasure of sharing the stage with Cameron Drinkwater, who's Chief Product Officer at S&P, Dow Jones Indices, and Kaiko as well. And that's like a whole conversation we had was around this. The fact that you can now, or eventually will be able to bridge, private market assets that are tokenized, being able to rebalance portfolios a little bit easier, and also mix them in with blue chip stocks, new strategies available, not to mention, of course, the crypto ETFs that we see today, and eventually multi-asset as well, right? So I'm really excited to see, again, how creative people can get, the new yields that can be generated or engineered rather, based on all of this, right? Again, we're not there today necessarily in terms of the infrastructure that's needed and the liquidity that's needed either for some of these assets to make it in just yet. But thinking optimistically of if we truly believe capital markets will come on chain, obviously this is definitely something that will be impacted. I know that we're getting close to time here, so we're approaching about $7 billion worth of yield coins, tokenized treasuries, whatever you want to call them. How big will this get in the next, call it 5 years, call it 2030? And are we talking like basis points of global debt markets, or a major, revamp here of fixed income?
So I'll take fixed income. Look, the beauty about fixed income is that these are not perpetual assets, right? They are originated and then they mature over time. These are all time duration assets. So I think over time, you could take my word that the fixed income market will come and originate on public blockchains, but we are far from that today. We have done 800 million ourselves. Other folks are also focused on it, so that's going to happen. The latest study from JP Morgan and a few other folks have estimated about $16 trillion worth of tokenized alt products by 2030. So that sort of gives you a benchmark of where we are headed. And these are some really, really large numbers. So my hope is that we move the whole ecosystem, but I think time will tell.
Yeah, I would add to that. I think it's very difficult to pin down a number, but I think what's going to happen is that in the next year or two, you're going to see regulatory clarity, and I think that's really going to start unlocking large-scale deployments. Because I think what we've seen to date has not really been any types of really issuances at size. Like if you're looking at the size of some of these issuances and sort of the traditional markets, the amounts we're doing on chain, if this was happening at scale, even within a day, you could see similar or larger sizes. And so I think it's going to be I think you're going to see these proof of concepts and these experiments really start scaling. You're going to see the deployment start scaling. But then at some point, it's just going to be a normalization. And I think you're going to then just see a massive hockey stick. I think at the point when it becomes standardized to issue these types of products on chain, all the tooling exists and you have the buy-in from all the big actors, you have the regulatory clarity. I could see very quickly us getting into the multiple trillions with these assets. Because if you're looking off chain, these are multi-trillion-dollar asset classes, credit markets are in the hundreds of trillions. And so I think, I would not be surprised if in the next 5 years we get to I think in the low single-digit trillions, and I think in a longer time frame, I think it's going to be in hundreds of trillions. But it takes time to get there. But I would expect the growth that we're seeing now to just keep accelerating. I see no reason why it wouldn't.
So I mean, there have been predictions like down to 4 trillion. We've seen a lot bigger than 16, 30, 35, etc. And so, for us, we made our own prediction of 30 by 30, right? But again, I think the major thing there is that, first of all, it's very hard to actually calculate that number. It's more so like really what's possible and what's going to be maybe some of those fringe cases that really bring assets on chain massively all in one, to the point where we're going to see a graph essentially looking like this, right? To your point, it's going to take the infrastructure and whatnot, and some major players to jump in, but we're already seeing some, starting to explore, and others are even expressing on bringing on full funds, not just feeder funds, but full funds on chain as well. So that's just the beginning of what we're seeing here. But really excited. Thank you, Robert. Thank you, Manish, for both of your insights here. I think you both really added to some color here on, above the normal conversations that happen around tokenized treasuries. So appreciate both of you guys. Any closing thoughts before we wrap it up?
No, thank you for hosting, and looking forward to tokenizing the world, really.
Tokenize the world.
Likewise, thank you for hosting. It's a really good talk. Thank you.
Yeah.
Thank you all. Augustine, I'll pass it back to you. Thanks for having us.
Thanks for joining us at STO Summit Spring 2025. Stay curious, stay connected, and remember, the future is tokenized.